My name is Steve Springer. I'm one of the partners with Stone Rudolph and Henry, and along with me this morning is Brandon Bork, certified financial planner with Roussel and Associates. And we're delighted to have you on board this morning. We're going to be talking about retirement plans for small businesses. And we thank you for spending some time with us this morning. We should be finished up in about an hour or so. And we certainly want you to take advantage of the opportunity to ask questions if you would like to do that. I think there may be a chat feature on your Zoom app there. So feel free to just type in questions and we'll get those and answer them as we can. So having said that, Brandon, what's the big deal about having to have a retirement plan? Can't you just save on your own for retirement? What's the advantage of working through a retirement plan?
Obviously, there are tax advantages, and we're going to talk about each main plan that's out there today that folks utilize. Most likely, that's the most important piece, is the tax benefits.
I would agree.
Yeah.
Well, there's several different kinds of plans that we're going to talk about today, and this is sort of an overview of each of these plans. We're going to give you some of the advantages and maybe some disadvantages of each one. Some of them you can implement later in the year. Some you have to meet certain deadlines, and so we hope we'll avoid confusion, but there are a lot of details that relate to each of these plans. We'll talk about the individual retirement account plans, the traditional, the Roth IRAs, what's called the Simplified Employee Pension Plan, or a SEP IRA. That's a great tool for a lot of self-employed folks. The Savings Incentive Match Plan for Employees, SIMPLE, if you spell out those letters, SIMPLE IRA, a 401k plan, which most of us have heard of, and a couple other plans that aren't seen that frequently, but they do have their place. You know, they can be used in certain situations, and those are the Defined Benefit Plan and then the Non-Qualified Deferred Compensation Plan. So we're going to jump right in and talk about the individual retirement accounts.
Yeah, and this education, this is more about education today. As we talk through these, if you've got some interest, obviously we're glad to answer questions. But really, it's a decision that you need to be making with your financial advisor and your CPA, hopefully, preferably together,
right?
Because they do have tax implications on all sides. So that's why we're going to go through each one, and then that's an individual conversation. So, all right, defined contribution plans. So they focus on current contributions to the plan, not a guaranteed benefit when you retire. You take the investment risk when it's a defined contribution plan, like a traditional IRA or Roth or 401k. Benefits based on investment performance. Like I said, there's no guarantee from that standpoint. Qualified retirement plans, deductible contributions, tax deferred earnings, and then taxable distributions on the backside. So that's your defined contribution plans, which we see most often nowadays.
Yeah, and your investment performance, I mean, that's a key piece of all this. That's really sort of a product of the amount of risk you're willing to take.
Yes.
It's also the time horizon that you have. I mean, obviously, if you make a contribution one year and expect to retire the next, there's not going to be much gain there. So the earlier you can start, the more opportunity you have for that to grow and grow. So yeah, these plans are great in that you can put a certain contributions in each year. You can always put in that much.
Yes.
But the limitation is, how much time you have before retirement, and then how well the markets are going to do, and you can't really control that.
2020 is a good example of that.
Right.
We've seen what the market's done this year. Been kind of a wild ride.
It has been.
But so you have to take a long-term view with all these types of vehicles, especially on the investment side. So let's move on. So traditional IRA, we see this the most. Anybody that's got taxable earned income can participate. So you've got $6,000 that you can put in for an individual. If you're over age 50, you can add another $1,000 on top of that. So you can get $7,000 a year in there. That's a pretty nice contribution for most households. There are some limitations if you have access to an employer plan, like a 401k. So there's some income limits, about the tax deduction. Got to get it in by the 15th of April. Well, there was a little extension this year, but that's just because of COVID-19, but that's passed and have to make those contributions. But typically in an annual year, if you're making a contribution for 2020, you've got till April 15th, 2021.
Right.
Okay. And then a spouse can certainly participate even if they don't have access to a plan. And then the earnings inside of the traditional IRA are, as we've talked about, tax deferred.
Tax deferred meaning that you're not going to pay tax on the interest, the dividends, the gains that accumulate in that account until you pull it out.
That's exactly right. You're deferring the tax.
Okay.
You're not avoiding the tax.
Right.
So it's purely a deferral. At some point in time, Uncle Sam is going to get his dollars out of that particular situation. But the thought process is, while I'm working, I'm in a higher tax bracket typically. And so that last dollar that I'm putting in, I basically get the deduction on. Hopefully in retirement, I'll pull those dollars out, hopefully in a lower tax bracket.
Right.
That's the mindset.
Right. And usually that's right. Usually that occurs.
Yes, absolutely. But that, as we know, Congress can change tax rates for sure.
Okay.
All right.
The Roth IRAs,
Yes.
and I spend a lot of time explaining the difference between these two.
Sure.
You could almost say it works just the opposite. You do not get a tax deduction when you put the money in.
Yep.
But when you pull money out years later, then all of it is tax-free. Both the amount that you put in originally, because you've already paid tax on that.
Correct.
The real benefit of this is that all that growth that has occurred over the years is tax-free.
Yes.
So this is a great opportunity for someone, especially someone young, to get started putting money into a Roth. Although it's really never too late, but those who get started earlier get the most benefit out of this.
Yes, absolutely. But it can be a great benefit, from my perspective as an advisor. I think people should have both buckets, some tax deferred and some after tax,
Right.
so that they can have different areas to pull from. Because as we all know, we're in this graduated tax scale. And so if you've got both buckets to pull from, where we see it being beneficial is at the end of the year, if I'm going to drop it, I'm going to step up to that next tax level, I could possibly live out of the Roth for a period of time,
Right.
avoid extra tax, and then in January go back to my traditional IRA.
Sure.
This gives you both options if you funded both at the right
Right.
time. But it's got the same contribution limits, $6,000 per year, $1,000 if you're an extra $1,000 for catch up if you're over 50. It does have income limits based on whether or not you're a single filer or a joint filer as a household. So if you make over those amounts, it gets phased out. Like for instance, for a single filer between 124 and 139. After 139, I can't participate. So if I've put money in, I've got to get with my financial advisor and take money out.
Right.
So
Right.
from that standpoint. Again, same due date on the tax return. Got to have it funded by the time I get to April 15th. But as you said, the earnings are all tax-free. So that certainly has a benefit. Now, if you pull out of either one of these plans before 59 and a half, you've got a 10% penalty tax. So Uncle Sam really does want you to put money into these vehicles, leave it alone, and not pull money out during that time period, so that you can truly use it for retirement. So that's where that disincentive is there before 59 and a half.
Right. Right.
Okay. And then there are some opportunities to, maybe a first-time home purchase. There are some exceptions around that 10% penalty, college expenses, some things of that nature.
Exactly right. And it depends on the type of plan, which one of those exceptions applies. But,
Yes.
but yeah, there are some ways you can get some money out without those penalties.
Yes, absolutely. On the Roth, if you participated for 5 years, you can actually go in and get your contributions
Right.
out without any.
As long as you don't pull the earnings
As long
out.
as you don't pull the earnings out. The penalty is really on the earnings itself.
So the original contribution comes out first.
Yes, that's exactly right. So nice little feature on that
It is
particular
nice.
piece for the Roth for sure
Okay.
on that piece. So
Yeah. I think our next slide is about the distributions
Yep.
on these plans.
unless you,
Well, as Brandon said, the traditional IRA, those distributions are going to be taxed.
Yes.
Because you have not paid tax on the contribution, you've not paid tax on the earnings. So when they come out at retirement or whenever you pull them out, you're going to pay tax on that. Now, with the exception of 2020, those people who've reached a certain age have been forced, they have to take what's called a required minimum distribution out of these plans, an RMD. And forever and a day, that age was like 70 and a half.
Yes.
All right. With the tax law change we had a couple years ago, that changed to 72.
Yep.
Except now for 2020, because of COVID,
Yes.
there was some tax relief in one of the acts that the Congress
The CARES
passed,
Act.
the CARES Act.
Yep.
And so for this year only, they're waiving the requirement to take those required minimum distributions. Now, if you need to take it
Yes.
for your income and your support, sure, you can take it,
Yes.
but you're not required to. So it's really a great opportunity. If you're not relying on that to live on, then you can let it sit there for another year and grow the account and grow a little larger. So
The thought process when it was passed, of course, the market was down further and had not recovered. And so the thought process is the calculation gets done on your 12/31 balance. And so everybody at that moment had a higher balance on 12/31 than what they would have been pulling out from. So Congress was trying to give everybody the opportunity for their accounts to come back up.
right,
So that they weren't pulling out of an account that was down 10% or 20%, depending on how much risk you're taking. So thankfully, the market has recovered from those lows, but certainly we'll maybe have some more speed bumps as we go down the road.
right.
But that was a nice feature.
It is. What about distributions on the Roth?
All non-taxable. Certainly, again, as I mentioned before, the 10% penalty before 59.5 on the growth.
Mhm.
If you've had it more than 5 years, you can pull out those contributions from that standpoint. So those are nice features for the Roth. But the word picture I typically use for most folks to try to explain the difference between the traditional and the Roth is on the Roth. Going ahead and let's say I've got a 100-acre farm, and I'm planting a crop. I'm paying the tax on the seed in that scenario, and then when the harvest comes in, I'm not paying anything on the harvest, and that's the growth. So just the opposite is the traditional IRA. I'm taking the deduction, and I'll pay the tax later, from that standpoint.
Yeah.
So,
and as you mentioned earlier, there are some exceptions to these penalties if you do have to take it out early. A few of those, they're fairly limited, but there are some where it might be real handy. If you have an emergency for a certain reason, you might not have to pay those penalties.
yes, yeah. Again, that's an individual conversation between you, your CPA, and your financial advisor as to whether or not you qualify on those particular issues.
Okay. All right. Well, those are the traditional and the Roth, and I think coming up next is the SEP IRA that we're going to take a look at.
Yep.
And this one's real popular with a lot of self-employed people. I see it a lot with, say, there's a husband and wife who operate a business, and maybe they don't have many employees, or maybe have no other employees.
Correct.
I've seen that used a lot in those situations. And one of the reasons is you can get a fairly large amount of money into the plan each year. It's like, for example, now up to like $57,000 a year. That's a whole lot more than that $6,000 you could get in the traditional IRA or the Roth.
Yes.
So being able to do that is a huge advantage. Being able to put that much money in and get a tax deduction in the current year for those contributions. But it does come with some restrictions. So if you have employees and you're going to be that generous to yourself,
Yes.
you're going to have to be very generous with your employees too. And sometimes that is part of the decision-making process.
Yes.
In this case, for example, an eligible employee would be someone who's worked there for you. They're at least 21 years of age. They've worked 3 of the previous 5 years, and they only have to make a minimum of $600 in the current year to qualify. So if you're, as an owner, if you're doing this full 20% of your income in for yourself, then the law says you have to put 25% of your employee's salary, their annual salary, in for them. And I have a few clients who do this, but maybe they usually only have 1 or 2 employees. It would be very difficult for an employer to put that much in for a large number of employees.
Yes.
But it does happen. And the nice thing with this plan too is you don't have to fund it every year. There's no requirement that
Completely discretionary.
Just because you did it this year, you don't have to do it next year. You can skip a year if you need to.
You can fund it and not fund it for 10 years.
Right.
So,
right.
And once the dollars get in there, it's just like any other traditional IRA. The dollars are going tax deferred. It's got all the 10% penalty, all that stuff for the future, you know, from that standpoint. And the nice thing about this particular one is you don't have to make that decision even by April 15th. You could actually file extensions and go all the way to your extension deadline, even set up the account and fund it. Obviously, it has to be done before the extension deadline. But you got lots of time to decide, does this make sense? You can almost know where you are for the next year, cash flow wise, before you ever make the contribution.
Right.
If you've done extension.
And that's one of the things that makes this plan so popular. Is,
Yes.
Right now, we're still working on some 2019 tax returns that should extended.
Yep.
Those folks have until October 15th, another few weeks from now, to make a decision about to fund or
The
not.
next deadline's coming up fast.
It's coming up fast. But so these decisions are going to happen pretty quickly. But man, you're right. You're 9.5 months through this 2020 year to know how much cash flow you have now to be able to fund a retirement contribution for last year. So
2019.
it's a huge plus for this type of plan.
Yeah, most often, like you said on the front end, we see this for people that are typically just, you know, basically working by themselves, you know, in a business. Maybe they have 1 employee, 2 employees, but like you mentioned, it does get kind of expensive. You've got multiple employees.
Right.
If you put in a contribution that's pretty sizable for yourself, based on these guidelines, if an employee meets those guidelines, they have to have a contribution too.
Right.
So, but it's a great plan.
And these are all employer contributions.
Yes.
In this particular plan.
Yes.
This
Employee cannot put money.
Right. This is not a plan that the employee can defer part of their salary or whatever. So this is all employer money that's getting put in. So.
Yes, absolutely. Gets the deduction though, pretty sizable one. If you're, obviously you don't have to put $57,000 in there. Your calculation could say you're supposed to put 21,000. That's still you know, it depends on your numbers, but obviously you have to work with your CPA, individual like yourself, to get that calculation first.
Right. Right.
Then you know what you can and can't do.
Exactly.
Then you can make your decision.
Sure.
For that part.
Well, I think the next plan that's come up is what we call the simple IRA, and it's quite different.
Yes. So it's got to be established by an employer before October the 1st. So
The clock's ticking.
the clock's ticking for sure.
If you're
That's next week.
If you're setting one up that's going to fund for
2019.
Yeah.
So it has to be a company that's got 100 or fewer employees. Participants must earn at least $5,000 in the current year or any 2 previous years. So you got a couple of options there. The employee contribution. So unlike the SEP, where there's no employee contributions, in this particular plan, the employee can put in just, you know, deferrals. The max is $1 amount today, and that's $13,500. Again, kind of like the traditional IRA, it does have a catch-up feature. So if we're over age 50, we can put another $3,000 on top of that from that standpoint. And then you want to talk about the employer match?
Yeah, a couple options here.
Yeah.
The employer can either match the employee contributions up to 3%. So if employees putting in 2, they can match that 2. The employees putting in 3, the employer could match that 3. Or the employer could do 2% basically for everyone.
Yeah, across the board.
Right. And as long as they do that, it's either or here. Then this plan can qualify. So.
Yes.
And
it's exactly like its name. It's simple. It's pretty straightforward. There's not a lot of you know, guidelines other than just signing that 5304 simple form, having in the file, making sure everybody that's eligible does participate or says they don't want to participate,
right.
And that you get your match in on time. You know, from that standpoint. So it's pretty simple. That's why a lot of small employers, you know, if they have, you know, less than 100 employees, we see this plan used quite frequently, you know, just because it's so efficient and does a great job. But you do have to make that match contribution. There are a couple of exceptions in a 5-year period of time where you skip a year if COVID-19 happens, which is, I'm sure, turned a lot of businesses around in different ways, this year. So there are some exceptions, but typically it's 1 year, and then you got to be right back on track to doing that deferral or the fixed contribution of 2%. So not a lot of flexibility there, but there's a slight amount of flexibility.
Right.
And then once the dollars get in there, it's just like the traditional IRA, where it's all growing tax deferred, both the money that the employee put in and the employer dollars. Has the same 10% withdrawal penalty. Actually, the first 2 years it has a 25% withdrawal penalty. So definitely don't want to take dollars out of those plans the first 2 years.
That's right.
Wouldn't make sense at all. And then there are some exceptions around that, for some same kind of reasons.
And we see a lot of companies that might either do a simple or maybe a 401k. And one of the differences is this is such low cost of administration,
Yes.
almost no cost.
Yes.
It's very low. And whereas with the 401k, there's a master account where all this money's invested together and allocated out among the employees, whereas this one, you're actually putting money in the employee's individual retirement account. So there's a lot less record keeping and things to keep up with on this. So that's why it's much lower cost.
Yes, absolutely. You do not have to have what's called, and we'll talk about this when we talk about the 401k in just a second, but you do not have to have what's called a third party administrator that is kind of the gatekeeper, so to speak, on all the rules. And that's why this particular plan is very popular with our small employers, and they use it quite frequently.
Sure.
It's a good plan. And again, it's an individual IRA, so each person has their own IRA. They're making their own investment decisions. The employer is not making any investment decisions for the employee.
Sure.
They're making their own investment decisions. So from that
It
standpoint,
removes that liability and responsibility.
fiduciary
Right.
liability.
Right.
Absolutely. For sure.
Okay.
All right. Man, we must be good. We're not getting any questions. Our explainer must really be working well today. All right. 401k. You want to start?
Well, it's about to get a little more complex.
Yes, absolutely.
And most people have heard of these plans, and they're certainly great plans.
Yes, absolutely.
There's a lot of great things about them. One of them is this higher amount of contribution. The employees are able to defer out of their wages or salary up to $19,500 this year. Now that changes periodically as the IRS makes changes, but currently it's $19,500. You can defer, put that money into the plan, and take a tax deduction for it. So
Yes.
it saves the employee a bunch of money. Also, if they're age 50 or older, there's a $6,500 catch up. So you're looking all together at $26,000 a year you can put into your plan.
Yes, much bigger numbers.
Yeah. So it really has a lot more impact on the tax side.
Yes.
But there are a few more strings attached. Now, some plans allow for Roth contributions, meaning that instead of getting your tax deduction now, you get your distributions tax-free later on.
Yes.
So you could go that angle. You could actually even mix it up a bit too.
Yep.
You could do some tax-deferred contributions and some Roth. So
it's nice to have that feature. Your SEP IRA and your simple plans do not have any Roth options on those particular plans. The 401k does allow for that. So,
right. But the rules are complex. This is a highly regulated sort of plan. It goes all the way back to what's called ERISA, and that's legislation that's back from the 1980s. I can't even remember what year exactly, about 85 or 6 or somewhere in there. I don't know. As long as I've been doing what I'm doing, those rules have been around. And
I think I was in elementary school.
Probably. And it's kind of a combination of regulated by the IRS and the Department of Labor.
Yes.
They both have influence on this legislation or these rules. So so it is a little more complex. As you mentioned earlier, you need that third-party administrator. That's a professional who all they do is
administer
plans to make sure that you stay within the
guidelines.
Exactly. Stay between the ditches and keep everything up to date, because Congress does change these rules from time to time. And so you have to make sure that any new rules that get passed each year get adopted into your plan.
Yep.
And those amendments get made.
and to have that third-party administrator, there's more cost
Sure,
involved.
sure.
You know, those people have to get paid for the part that they do too. So that's why I see our smaller employers typically stick with the simple. As companies grow, the 401k becomes a very viable option.
Sure.
And the cost makes more sense as it grows.
They're not cost prohibitive.
No, correct.
But there's definitely more cost with
Yes.
these plans than.
They have to be tested every year. That's another part of the function of the TPA. You turn in a testing spreadsheet. You have to show what amount everybody put in, and you have to make sure that matches back to your W-2s,
Right.
and that no one individual or what's called highly compensated individuals are putting in too much money. So the government really, but again, as long as you stay within all those guidelines, and that's what the TPA is helpful at, making sure you do, it can be a wonderful plan. You can get a
Absolutely.
lot of dollars in there, and it can be a great thing for you and your employees from that standpoint.
Right. Employers do have the options to contribute or not contribute each
Correct.
year.
Yes.
You know?
Yep.
And so there's some years, I've seen this happen many times with clients, that some years employers contribute and some years they don't,
Yes.
but the employees can still be deferring and putting money in. Another
Yes.
great feature of these, if the employer includes it in their plan, is participant loans.
Yes.
And that's something that none of the other retirement plans that we've talked about have a feature like that.
Correct.
So in this case, you could actually borrow out of your own account.
Yep.
And essentially pay yourself interest
Yes.
by paying that loan back. Now, these loan payments have to be made through payroll.
Yes.
It's a payroll deduction.
Comes straight out of your paycheck.
And there are limitations as to how much you can borrow and what the time.
Generally,
Period.
50% of the account balance.
Right.
It's generally how that is. You've got to pay it back typically over a 5-year period.
Right. Right.
For the most part.
I had a client this week who called.
Okay.
Very same situation. They were wanting to buy an investment property.
Sure.
And actually one that their daughter was going to live in when she went off to college.
Sure.
And they wanted to get a down payment on this property, so they actually borrowed from their 401k, which makes perfect sense. You know, take out the loan and pay yourself. You know, you
Pay yourself back.
absolutely. So that was a great opportunity for them. It was a great way to use that loan feature.
Yes. Absolutely. Certainly would have the conversation with them about how low rates are right now.
Right.
So,
Right. Right.
in the current environment that we're in. But the employer can decide to make contributions. They can do a match. They can do something like across the board. They can also add what's called a profit sharing feature to these types of plans. We see that very frequently. In those scenarios, you got to be fair. And it's kind of like the SEP IRA. If I'm making a 10% contribution for myself as a profit sharing, I got to do 10% for everybody across the board. So again, there's a lot of rules and regulations. But like the SEP, between all those different contributions, you can get up to the 57,000 number.
That's a lot of money.
It's a lot of money.
And a lot of tax savings, considering
Yes.
that's all tax deferred. So.
Yes, it has the same 10% early withdrawal penalty. And depending on your distribution rules, which the employer actually sets on the front end when they're setting up what's called their plan agreement, they can decide, how and when they're able to take dollars out of there.
Right.
And typically, while you're participating and working for the employer until you get to 59.5, typically the dollars have to stay in there. Once you leave, the employee has the opportunity to either roll that to a new 401k or a traditional IRA once they've left. But typically while they're there, the dollars have to stay in the plan.
Right.
You can do what's called a safe harbor contribution as an employer. And in that scenario, it gets you around some of those testing rules and allows a lot of times our employers who want to max out the opportunity to max out. So there's a lot of nuances. Definitely needs to be a conversation where you're sitting down and have your CPA at the table, your financial advisor, and preferably already be working with a third party administrator so that everybody's on the same page because there are a lot of rules that you got to keep up with, and everybody's got to be on the same page from that standpoint.
All right. And like all the other plans, penalties apply if you pull money out early and those sort of things. So that's really there just to encourage people to save. I mean, that's
Yes.
That's the whole incentive for the government, is to get people to save for their own retirement.
Absolutely, which certainly you and I think very important. One thing I will say about the Roth contributions, that's unlike the Roth IRA, there is not an income limit on the Roth 401k contribution. So before, when we were talking about the Roth,
Right.
we were listing those contribution income limits. In this particular scenario, there is not. So not sure why Congress did it that way, but for the 401k, doesn't matter how much money you make, you can use the Roth feature, which for a lot of our folks who've been blessed and worked hard and had an opportunity to make a little bit more, this is a great opportunity if they have the 401k,
Right.
for them to do some Roth where they couldn't do it when it's just using a traditional Roth IRA, actual Roth IRA.
That's a great point, and it kind of brings up a thought. You can have a plan just for one individual, right?
You can do what's called a solo 401k.
Right.
Yes.
And we've talked about the expense involved here, so that certainly has to be a factor. But if it's a high-income individual, they're in their peak earning years,
Yes.
they may very well want to do something like this to sock away a lot of money during those years and get some great tax benefits out of it.
Absolutely. Absolutely. Has great features. Want to make sure people knew that feature's there.
Right.
Which is very nice for our folks.
Absolutely.
Okay.
Well, what's our next plan?
Next plan. I think we're moving on to defined benefit plans.
Don't see these quite that often, but they certainly have their place, don't
They do. It's kind of a different scenario, but all the plans we've just covered, you're defining what you're putting in, or what you can, the government's defined what you can put in annually.
Right.
In this particular scenario, I'm trying to define an income stream in the future, and then I have to work with again, typically a third-party administrator to decide how much I need to put in each year in order to get that income.
Right. So you're kind of backing into the contribution amount
Yes.
based on the time between now and retirement and how much income you need at that point.
Yep. How much I need to put in each year to get to that end game number. So I'm defining what I'm going to receive later. So it's kind of the very opposite from that standpoint.
So if I wanted $10,000 a month in retirement, then they would back into the amount that I need to be putting in now based on some assumed rate of return.
Yes.
In this time horizon that I have.
Yeah. So if I'm young, that number per year to fund it and get to that end goal may be a lower number.
Right.
If I'm real close to retirement and I'm trying to get to that end number, then I may be able to put some significant dollars away.
Right.
And typically we try to tell folks, when you commit to a plan like this, you need to kind of think in at least a 5-year increment, that I'm participating for at least 5 years. There are exceptions, like anything else in this world, where you can back away if something were to happen to your business. But generally, on the front end, we try to make sure people are at least committed for at least a 5-year period, where it could be longer than that, obviously, from that standpoint. So they're very different from your normal. You used to see them a lot as pension plans, but now most employers are moving away from those old pensions where mom and dad worked for a company for 30 years and then got X dollars when they left. Most companies are moving to the defined contribution and limiting some of their liability for the future. But we still see this plan used pretty significantly, typically, like you said, with employers that are smaller and want to put away some significant dollars.
Right.
You get a deduction.
And probably one of the reasons for that is people are living so much longer.
Yes. Yes.
That employers were having to put more and more dollars in to fund the retirement of folks who are going to live another 10 or 20 years beyond what they had originally anticipated, maybe.
Absolutely.
Yeah. So, all right. So, great benefit really to older people in particular, in the sense that they can put in more dollars.
Yes.
Get a larger tax benefit with those contributions.
Say somebody's 55, they're making decent money and want to get a sizable benefit, put away for the future. Don't have a lot of employees. Again, this is just like any other ERISA plan.
Right.
If you've got employees, they have to be included. There's guidelines and rules and regulations and all that stuff. But typically where we see this used the most, maybe I'm in that mid-50s range. I got maybe 10 years to go. Maybe I got a couple of people that are younger than me, so I don't have to put as much away for those particular individuals. I still have to do something,
Right.
which I will certainly do. And then for myself, I can put away some significant dollars over a 5-10 year period of time to get a tax deduction.
This one really requires a lot of consultation with your
Yes.
with your professionals, with your
Yeah.
investment advisor, your CPA, your TPA, all
Yes.
those folks.
And depending on how the investments perform, that changes that trajectory for how much you can get a deduction on and put away each year as well. So if the market's doing well and you're ahead of schedule for getting to that benefit, then it kind of cuts down on the amount of money you can potentially put away. So how your investments perform are very important as well. That's why the TPA will take a snapshot each year. They want that 12/31 balance or planned balance so that they can do the calculation for the following year.
Right.
So.
And these are all going to be taxable distributions.
Yes.
Because
Yes.
there's no Roth type feature in these types of plans.
No.
So you're getting the big tax deduction on the front end, but then when you pull it out in retirement,
Yes.
hopefully at a lower tax rate,
Sure.
then you're going to pay tax at that point.
Yes. People ask me all the time, Brandon, what am I going to pay in taxes when I pull this out? I go, it just depends on where Congress is and,
That's right.
and what rules they set
Right.
for the year that you're pulling this out. We've, through you and I's professional careers, we've had a graduated tax scale, and long before you and I were doing this, I would assume we will continue to have a graduated tax scale where you pay more on your last dollar than your first dollar.
Right.
So the thought process, again, kind of like the traditional IRA or the 401k that you're doing pre-tax is, I'm getting a deduction on that higher, income level, and then hopefully when I pull it out in retirement, I'm pulling it out at a lower income level and paying less tax.
Right. But there are no guarantees,
guarantees.
that things are going to stay the same.
Correct.
And avoiding politics altogether, but
Sure.
at least one of our candidates running for president has said they may replace the tax deduction that you get on 408, 401k contributions with like a tax credit. So that's interesting to me. It'll be interesting to see if that happens, how that would get rolled out. But the point is that things can change.
That's exactly right.
There's no guarantee that things will always be the way they are now. So.
No, these guidelines and contribution limits change and adjust, almost every year or every tax legislation that's passed, which keeps you and I on our toes.
Well,
try to keep up with it all.
Well, that's why it's important that employees, folks who are out there saving, that they consult with their professionals.
Yes.
At least once a year to find out what the changes are and how that's going to impact them.
Yes. Just like going back to the CARES Act and the required minimum contributions for this year, we've reached out to everybody and say, hey, you don't have to take your required minimum distribution this year. You still can, but do you want to? So that's where it's got to be a relationship, back and forth. We've had some people call us before we called them. Most people we've called before they've called us. So, all right. All righty. Moving on. Non-qualified deferred compensation plans.
Even more limited.
Way more limited.
Don't see these just a whole lot, but basically, this might be a way that let's give a scenario. Maybe you have a company where they have an individual that they would like to reward with some additional retirement contributions or something, but they're limited by all the, I think we may have a question here. Let's do that first.
Sure. I don't see a question. Yeah, I've clicked on it. I just don't see the question, so I apologize.
There you go. No,
There we go. Now I'm there. Sorry about that. We're all still learning how to use Zoom and all this new technology.
I didn't know how to spell Zoom 1 year ago. Now we use it every day.
Yeah, absolutely. Yeah. We do appreciate the question. So this takes us a second to get there. If I'm contributing to a Roth 401k at work, can I still contribute to a traditional IRA? again, that comes back to those income limits. If I'm participating in any type of 401k, whether it's traditional or Roth, I've got to get with my CPA and look at those income rules, which decides whether or not I can actually participate.
I'm going to pull that back up just to kind of address that question.
Steve's got it.
So and I don't know whether you're single or married, so I'll address both. And so you're participating in a 401k at work, all right, and you want to do a traditional IRA contribution. If you're a single person, your ability to make that additional IRA contribution phases out as your income goes from 65 to 75,000. So if you're single making over 75, you cannot make a traditional IRA. So now if you're married, you're filing a joint return, then your ability to make that traditional IRA contribution phases out as your income goes between 104,000 and 124.
Correct.
Once you reach 124, there's zero contribution that you can make to the traditional IRA. So I hope that helped. That's one of those things that you have to look at. Are you participating? Yes, we know you're in that 401k, and you've got to look at your income to know whether or not you can make the additional contributions. And not a lot of people know that. You and I both spend a lot of time in tax season undoing contributions sometimes, where folks have put in money that we determined, you weren't allowed to do that. So now you have to go back and pull that out, pull the earnings out, and basically undo those contributions. So it's better to know on the front end whether it's allowed or not, to save a whole lot of paperwork.
Yes. And what I would make sure of, and again, we just have one question, so we don't have all the facts. I'd be more happy to have a conversation afterwards if we need to.
Sure.
But are we maxing out the 401k? Because in the 401k, I can do both.
Right.
I could split up my contributions, half and half for Roth, as long as it's allowed, and pre-tax.
Right.
So make sure that if you can't do the traditional IRA based on income, that I'm for sure maxing out what I'm doing on the 401k.
Absolutely.
And I could put it in both buckets, or utilize both buckets.
Right.
Okay. Great question. We see that one pretty regularly. All right, back to non-qualified deferred compensation plans. Typically where we see these, Steve, is somebody, an employer already has their 401k. They've already got folks that are participating, and the individuals that are maybe running the company, executives or whatnot, they've already kind of maxed out the 401k, and they're looking for an arrangement where they can continue to put away some more dollars over and above that.
Right.
It's typically where we see these types of plans.
I'll give you an example too. In my background, I've worked with a lot of banks, and I see for example, where banks have people who serve on their board of directors, and they get paid for committee meetings and board meetings and all that. And a lot of the banks in particular will set up these deferred comp plans where those directors can, in lieu of receiving those director fees currently, they'll put them into these deferred comp plans, and that allows them to sit there and grow tax deferred. And then when they retire from the bank board, they've got a nice income stream based off of the money that's accumulated in those plans. So, and you could use that same concept. Doesn't have to be a bank. You could use that same concept with any business.
Yes. Absolutely.
Just another way to defer the money. Now, you're not getting a tax deduction when you put it in. All right. You'll get that later on when you start pulling it out. So once someone starts paying tax on that money, then you'll get the contribution based on how much was put in there originally. But it's a great opportunity, especially like you said, for people who've already maxed out all they can do in their routine retirement accounts, the ones that are most common, and then they can set up these special arrangements for additional dollars later on. So.
It is typically the executives of the corporation in this particular scenario where we see this. And sometimes the liabilities, we see the last point down there at the bottom, sometimes it's unfunded and sometimes it's funded. So sometimes employers are going ahead and setting up what I would call a sinking fund, so to speak, and having a nest egg to pay that income in the future. And sometimes it's considered an unfunded liability, so to speak, where they just pay it out of cash flow to those individuals down the road. So.
Yeah. And the obvious downside to that is
Sure.
you're kicking that liability down the road. So you hope that that company has earnings in the future to be able to afford to pay those benefits. So,
Yes, absolutely.
So funding is a great way to go if you can afford to do that. Yeah.
Yes, absolutely. But there's, again, you've got a third-party administrator involved in these types of plans to make sure that you're staying within all the guidelines. So there's quite a few wrinkles. As we've gone through each plan, going from the traditional IRA and the Roth IRA, which are in the simplest form of retirement plan and tax benefits, this is the very end with the most complexity, so to speak, behind the defined benefit plan,
Right.
where you need some real guidance and help.
Sure.
To make sure you're pulling all the pieces of the puzzle together.
Yeah, one thing we don't want to lose sight of too is that retirement plans are just one part of
Yes.
your overall retirement plan.
Yes.
Hopefully.
Should be.
Yeah, should be. It's one component of it. So
Very important. Great piece.
Oh, it absolutely is. The tax benefits, as you
Yes.
said at the beginning, are tremendous. But it's also important to have money saved outside of retirement plans.
Sure.
That's accessible and
Yes.
without
Without the penalties,
penalties.
all those types of things.
Exactly.
So for instance, this year we've seen some employers, just going through this crazy situation that we call COVID-19, have to dip into some things that they never thought they would ever have to dip into,
Right.
just because of the situation and the circumstances. So thank goodness those opportunities are there,
Right.
to utilize, but that's why we also always recommend that you have some dollars for retirement outside of these types of plans, even though they're fantastic. Take advantage of them, and certainly have some liquid dollars that you could dip into,
Right.
for emergencies.
And the thing that really drives how much you need is how do you want to live?
Your lifestyle.
Your lifestyle. You're going to have to make a plan. At some
Yes.
point, you have to sit down with someone like you who can help you, devise a plan for the future. But it's really based off how much are you going to spend? How much do you need in retirement?
Yes, absolutely. That is the finite number that we got, and we can adjust that number.
Sure.
But I tell people that's the first number we got to start with. If you need $5,000 a month, that's one nest egg for retirement. If I need $10,000 a month, well, we're going to have to save a whole lot more. So, anyways, I tell people all the time, it's financial planning. It has an ing on the end, and you have to be willing to adjust because things are going to change. Market circumstances are going to change. Life circumstances are going to change. Rules and retirement plans are going to change. And so it's not just something we stick in the drawer and never pull back out. It's something that is a constant evolution,
Sure.
so to speak, through time. That's why it's got an ing on the end.
It's ongoing.
It's ongoing. That's exactly just like tax planning.
Right.
It is
Exactly
ongoing,
right.
for sure.
Exactly right. Okay.
Yeah.
Do we have any other questions from our participants out there?
Our explainer's been pretty good today, Steve, I guess.
Apparently so. Any questions on anything? You want to stump the panelists here? Feel free to go ahead. We talked about a lot of different plans,
We have.
and it probably raised some questions for folks. And so we just want you to know that after this session is over, if you've jotted down some questions, why don't you email us? And we'll be happy to get you some answers to your questions, or if you want to sit down one-on-one
Yes.
and talk through, which one of these plans is really best for me, based on all the different criteria, based on how much I can afford to put in, which ones would work best. We're happy to do that. That's something we do all the time. And so there's our information on the screen there.
It's typically just an individual conversation, and I know you take calls all the time. I take calls all the time. We don't charge to have those kind of just initial conversations, just
Right.
to see where somebody's at, what they're trying to accomplish. We try to help them, educate first,
Sure.
and that's what a big part of what we try to do today is educate. and then try to laser beam focus in on what fits each individual based on their current circumstances for their business, for their lives, and where they're trying and what their goals are
Okay.
at the end.
Yeah, sure.
So,
All right. Well, if there are no additional questions, then we'll just say thank you. And we
Absolutely.
really appreciate you being with us today. If there's any way we can help you in the future with retirement plans or questions on other financial matters, we're here to help. And it would be our pleasure to do that. You have our information. Shoot us an email, give us a call if you have questions. But thank you for being here, and we hope you enjoy the rest of your day.
thank you for your time. Have a great day. Stay safe.